Ladies and gentlemen, what if I told you that one political move just changed the outlook for silver overnight? While most investors are focused on headlines, something much bigger is happening beneath the surface. Trump's latest policy shift is sending shockwaves through global markets, and now Jamie Dimon is issuing fresh warnings about what could come next. Is silver about to break out, or are investors walking into another trap? Today, we'll connect the dots between politics, banking, inflation, and the silver market to uncover what many people are still missing. Markets rarely move because of a single headline. They move because a headline changes expectations. That distinction matters more than ever. Investors often look at the price chart after a major political announcement and assume the market is reacting to today's news. In reality, professional money is already asking a much larger question. What does this mean 6 months from now? What does it mean for inflation, interest rates, government spending, business confidence, and ultimately the purchasing power of the currency? Those are the questions that drive capital flows, and those are the questions that matter for precious metals. When uncertainty increases, investors begin reassessing risk. They start looking beyond quarterly earnings reports and short-term economic data. Instead, they focus on preserving wealth in an environment where the future becomes less predictable. That shift in psychology doesn't happen overnight, but once it begins, it can have a lasting impact on financial markets. One of the biggest mistakes people make is believing markets always reward certainty. In many cases, markets actually thrive on expectations. When expectations suddenly change, volatility follows. Stocks may swing sharply, bond yields may fluctuate, currency markets react almost instantly. Precious metals often begin moving quietly before the broader public even notices. This is why political developments deserve close attention. They don't simply affect government policy, they influence how businesses invest, how consumers spend, and how central banks respond. Every significant policy decision creates winners and losers, but it also creates uncertainty. History has shown repeatedly that uncertainty encourages investors to diversify into assets that are not someone else's liability. Silver occupies a unique position during these periods. Unlike many financial assets, it doesn't depend on a company's profits or a government's promise to repay debt. It exists outside the traditional financial system while also serving an important industrial purpose. That combination makes it different from nearly every other asset class. What makes today's environment especially interesting is the number of moving pieces happening simultaneously. Inflation concerns haven't disappeared, government debt continues expanding, interest rate expectations remain fluid, global trade relationships continue evolving. Each of these factors influences investment decisions, and together they create a backdrop where traditional assumptions become less reliable. Markets dislike uncertainty because uncertainty makes pricing risk more difficult. Investors can calculate expected earnings, they can estimate economic growth. What becomes challenging is assigning value when future policies remain unclear. That's when defensive positioning begins. Some investors move into cash, others increase bond exposure. Many institutional investors begin allocating toward hard assets. This isn't necessarily because they expect an immediate crisis. It's because they recognize that diversification becomes more valuable when outcomes become harder to predict. Silver has historically demonstrated this characteristic during major economic transitions. It doesn't always respond immediately, and it certainly doesn't move in a straight line. In fact, silver is well known for frustrating both bulls and bears. It can remain quiet for extended periods before suddenly making significant moves that catch most investors off guard. Patience has always been one of the most underrated qualities in precious metals investing. Markets frequently test conviction before rewarding it. That's especially true for silver because it sits at the intersection of monetary demand and industrial demand. Those two forces don't always align at the same time, but when they do, the market can tighten much faster than many expect. Another important consideration is investor psychology. During periods of confidence, capital tends to chase growth. Investors seek higher returns and often ignore defensive assets. As uncertainty rises, priorities change. Wealth preservation becomes just as important as wealth creation. That subtle shift can redirect enormous amounts of capital across global markets. Institutional investors understand this dynamic well. They don't wait until every risk becomes obvious. They monitor changing conditions continuously, adjusting portfolios gradually rather than making emotional decisions after markets have already moved. Individual investors often do the opposite. They wait for confirmation from headlines, social media, or television commentators. By the time the story becomes obvious, much of the opportunity may already be reflected in prices. That's why understanding macroeconomic trends is far more valuable than reacting to daily news cycles. None of this guarantees higher prices for silver tomorrow or next week. Markets rarely reward certainty, and anyone claiming to know exactly what happens next is oversimplifying a very complex system. What matters is recognizing when the balance of probabilities begins shifting. The current environment suggests investors should pay close attention to monetary policy, fiscal decisions, currency strength, and global confidence. These variables interact constantly, creating conditions where market leadership can change quickly. Silver doesn't require panic to perform well. It simply requires an environment where confidence in traditional financial assets becomes less absolute. Even modest changes in investor allocation can have an outsized effect because the silver market remains relatively small compared to stocks or bonds. That's why experienced precious metals investors focus less on daily price movements and more on long-term fundamentals. They understand that volatility is normal, corrections are inevitable, but they also recognize that structural shifts often begin quietly, long before they become front-page news. Ultimately, markets are forward-looking mechanisms. They continuously price tomorrow rather than yesterday. Every major political or economic development forces investors to reconsider assumptions about growth, inflation, debt, and financial stability. Those changing expectations ripple through every asset class, including precious metals. Whether silver responds immediately or takes time to build momentum, the underlying forces driving investor behavior deserve careful attention because history has repeatedly shown that when expectations change, markets eventually follow. One of the most valuable habits an investor can develop is paying attention to what experienced financial leaders are saying, not because they're always right, but because they often have access to information and perspectives that the average market participant does not. When respected figures begin expressing caution about the broader economy, it's worth listening carefully. Their comments are rarely intended to predict an exact date or event. Instead, they serve as reminders that financial risks are building beneath the surface, even when markets appear calm. It's easy to become comfortable during periods when stock indexes are performing well and economic reports seem reasonably positive. That's human nature. People tend to believe that current conditions will continue indefinitely. History, however, tells a very different story. Every economic cycle eventually changes. Booms give way to slowdowns, periods of easy credit become periods of tighter financial conditions, and optimism eventually encounters reality. One of the biggest concerns facing today's economy is the growing level of debt across multiple sectors. Government borrowing has increased significantly over the years, corporations continue carrying substantial obligations, and many households remain sensitive to higher borrowing costs. Debt itself isn't automatically a problem. The issue arises when interest expenses consume a larger share of income, leaving less room for productive investment and economic growth. Higher interest rates have changed the financial landscape. For years, businesses and consumers became accustomed to borrowing at historically low costs. That environment encouraged expansion, investment, and spending. As financing becomes more expensive, those same decisions require much greater scrutiny. Projects that once appeared profitable may no longer make economic sense. Consumers may postpone large purchases, and businesses may reduce expansion plans. This is where economic momentum begins to slow. It rarely happens all at once. Instead, the process unfolds gradually as tighter financial conditions work their way through the economy. Markets often recognize these shifts before they become obvious in official economic data. Inflation also remains an important piece of the puzzle. Even if inflation has moderated from previous highs, the cumulative increase in prices continues affecting households and businesses alike. The cost of essentials remains elevated compared to just a few years ago, placing pressure on disposable income and profit margins. Persistent inflation creates a difficult balancing act for policymakers because efforts to reduce inflation can also slow economic activity. Investors should understand that markets don't simply react to current inflation numbers. They respond to expectations about future inflation. If participants begin believing that inflation will remain stubbornly above desired levels, financial markets adjust accordingly. Bond yields, currency values, and precious metals all respond to those changing expectations. Another factor that deserves attention is confidence. Modern financial systems operate largely on trust. Banks trust borrowers to repay loans. Investors trust markets to function efficiently. Consumers trust that their purchasing power will remain relatively stable over time. When confidence begins eroding, even modestly, financial conditions can tighten surprisingly quickly. Confidence isn't measured by a single statistic. It's reflected in countless individual decisions made every day. Businesses delay hiring, families postpone major purchases, investors reduce exposure to riskier assets, banks become more selective when extending credit. Individually, these actions may appear insignificant, but collectively, they influence the direction of the economy. This is one reason precious metals continue attracting attention during uncertain periods. Gold and silver have served as stores of value for centuries, not because they generate income, but because they exist independently of the credit system. They don't depend on someone else's promise to perform. That characteristic becomes increasingly valuable whenever confidence in financial assets begins facing challenges. Silver occupies an especially interesting position because it benefits from two distinct sources of demand. On one side, investors seek it as a monetary asset during periods of economic uncertainty. On the other, manufacturers require it for a growing range of industrial applications. These two demand drivers don't always move together, but when they reinforce one another, they can create meaningful pressure on available supply. It's also important to remember that financial markets frequently underestimate long-term structural risks. Investors often become preoccupied with quarterly earnings, monthly employment reports, or daily price movements. Those indicators certainly matter, but they don't always reveal the broader trends shaping the future. Long-term challenges such as rising debt burdens, demographic shifts, infrastructure needs, and fiscal deficits develop slowly. Because they evolve over many years, markets sometimes ignore them until conditions reach a tipping point. By then, adjustments can occur much faster than most people anticipate. This doesn't mean an economic crisis is inevitable. Financial systems are remarkably resilient, and economies possess an impressive ability to adapt over time. Businesses innovate, consumers adjust spending habits, and policymakers respond to changing circumstances. The future is rarely as extreme as either the most optimistic or most pessimistic forecasts suggest. However, prudent investors recognize the difference between prediction and preparation. Preparing for uncertainty doesn't require expecting disaster. It simply means acknowledging that economic cycles continue to exist and that diversification remains an essential part of sound financial management. One of the most overlooked concepts in investing is risk management. Many investors focus almost exclusively on maximizing returns while paying insufficient attention to protecting capital. Yet preserving wealth during difficult periods often contributes more to long-term success than achieving extraordinary gains during favorable markets. Silver has historically demonstrated considerable volatility, which means it shouldn't be viewed as a guaranteed path to profits. Price swings can be significant, and patience is often required. Nevertheless, many experienced investors consider holding at least some exposure to tangible assets a sensible component of a diversified portfolio, particularly when economic uncertainty begins increasing. Ultimately, the broader message is not about fear, it's about awareness. Financial markets are constantly evolving, and conditions that appear stable today can change more quickly than expected. Rising debt, persistent inflation pressures, shifting monetary policy, and changing investor confidence all interact in ways that influence every major asset class. Successful investors avoid becoming complacent. They monitor long-term trends instead of reacting emotionally to daily headlines. They understand that preserving purchasing power is just as important as pursuing returns. Most importantly, they recognize that uncertainty isn't something to fear, it's something to prepare for. History has shown time and again that those who remain disciplined, diversified, and focused on fundamentals are often better positioned to navigate whatever the next stage of the economic cycle may bring. Silver has always been one of the most misunderstood assets in the financial world. It doesn't behave exactly like gold, and it certainly doesn't move like stocks or bonds. That unique character is precisely why so many investors struggle with it. They expect immediate results, become discouraged during long periods of sideways price action, and often lose patience just before the market begins to move. If history teaches us anything, it's that silver has a habit of surprising both skeptics and believers when conditions finally align. What makes the current environment so interesting is that several long-term forces appear to be moving in the same direction. Individually, none of these factors guarantees a major price increase. Collectively, however, they create a backdrop that deserves careful attention. Successful investing isn't about predicting the future with certainty. It's about recognizing when the probabilities begin shifting in your favor. One of the strongest foundations supporting silver is its dual role in the global economy. Unlike many commodities that are consumed primarily for industrial purposes or held mainly as financial assets, silver serves both functions simultaneously. It has been recognized as money for thousands of years, yet it also remains one of the most important industrial metals in modern technology. That combination gives silver characteristics that few other assets possess. Industrial demand continues evolving as technology advances. Silver's exceptional electrical conductivity, thermal conductivity, and resistance to corrosion make it extremely difficult to replace in many applications. Engineers don't choose silver because it's fashionable. They choose it because in many cases it performs better than alternatives. As industries continue developing more advanced electronics, energy systems, medical technologies, and communication equipment, silver remains an important component in many manufacturing processes. At the same time, investment demand has the potential to change much faster than industrial consumption. Manufacturers generally purchase silver according to production needs, while investors respond to economic conditions, inflation expectations, currency confidence, and market sentiment. When investor demand accelerates during periods of uncertainty, it adds another layer of pressure to an already active market. Supply is another part of the equation that deserves attention. Many people assume higher prices automatically lead to substantially greater production. In reality, mining doesn't work that way. Developing a new mine can take years of exploration, permitting, financing, construction, and infrastructure development before meaningful production begins. Even expanding existing operations requires significant planning and capital investment. Another important point is that much of the world's silver isn't produced from mines dedicated solely to silver. A large percentage comes as a byproduct of mining other metals such as copper, zinc, or lead. That means silver production often depends more on the economics of those primary metals than on silver prices themselves. Even if silver becomes significantly more valuable, overall production may not increase rapidly if base metal mining remains unchanged. This creates an interesting dynamic. If investment demand rises while industrial demand remains steady or continues growing, available supplies can tighten faster than many market participants expect. Markets don't require a complete shortage to experience higher prices. They simply require demand to grow faster than supply can respond. Investor psychology also plays an enormous role in silver's price movements. Precious metals often spend long periods being ignored while attention remains focused on high-performing sectors like technology or growth stocks. During those periods, silver can appear dormant, leading many investors to conclude that nothing significant is happening. Yet beneath the surface, long-term accumulation may already be underway. Then comes the transition, confidence begins shifting, economic uncertainty increases, inflation concerns reappear, or financial markets experience heightened volatility. Investors who previously ignored precious metals suddenly start paying attention. Because the silver market is relatively small compared to global equity and bond markets, even modest increases in investment demand can have an outsized impact on prices. This is one reason silver has earned a reputation for making powerful moves over relatively short periods. It often spends months or even years building a foundation before momentum accelerates. By the time headlines begin discussing silver's strength, much of the initial move has already occurred. Patience is therefore one of the most valuable qualities an investor can possess. Silver rarely rewards emotional decision-making. Chasing rapid rallies or selling during temporary corrections often produces disappointing results. Those who understand the long-term fundamentals are generally better prepared to navigate the inevitable volatility. Monetary policy also